excited to be able to introduce her to you guys because she also invests in real estate, so she knows all about the ins and outs of the, taxes and stuff around that. So just I'll let her share her knowledge. I'm always impressed every time she speaks, and she's just a great human being in general. Love you, Zoe.
Thank you, Rory. Okay, let me see if I can share my screen. Okay,
You're good.
okay, I'm good. So I'm gonna get started. Hi everyone, good evening. My name is Zoe Zhou. I'm the tax partner with Hawk Evans Company. I have been in public accounting for see if I can move. I've been in public accounting for 18 years. So most of my clients are small business owner. And I do income tax planning and help them optimize their tax, and also do a decent amount of trust estate consulting and compliance. And also I have a lot of client real estate, the realtor client and the real estate investor, also the dealer client. And with my unique background, I'm a first generation immigrant from China in 1999, so it has been over 20 years. So I do a lot of international tax consulting, and especially I'm specialized in FOPTA tax consulting, and mainly is the tax withholding rule for when foreign person selling the real property in US. And most of escrow company in Eugene has my contact information for referral purpose. Okay, I have some agenda for tonight. Hopefully I have enough time to cover all of them. First, I'd like to visit the tax consideration for real estate investor. Mainly it's for individual investor. And I know you guys are talking about house flipping. So I think a tax consequence of fix and flip is probably the topic most people will be interested. And I like to give people some planning idea and the tip how to become a tax smart flipper. And if your activity, your flipping activity raise to a level of like a business, because if the IRS treat you as a dealer, not just the individual investor, what the tax saving you can put on to save your tax. Most popular the saving technique is we do S election for people business, so they can save the self-employment tax. And if I have time, and I like to touch on briefly the 1031 exchange, which is the unique opportunity for individual investor. So this is my plan, and I plan to cover my material about 60 to 70 minutes. Then we have some 15 minutes for people raise question. You can put your question in the chat. If I cannot answer, you can feel free to email me. I have my contact information in the cover page, so you have my email and phone number, and I will just try to answer them whenever I can. First, I know you guys are real estate investor, savvy investor, and probably this will be a review for most of you, but I think that some recap probably necessary before we get to touch to the fun part. So basically there's two types of federal tax for real estate investor. Most people holding a rental property, so you pay income tax on your rental income. When you eventually sell your property, and you pay capital tax, capital gain tax. This is the two major income tax consequences when you're holding the real estate investment. And when you have your rental property, you have the regular deductible expense, like mainly maintenance expense, mortgage interest, property tax, insurance, repair, If you have a residential property, then you have 27 and a half years the cost of recovery, which we call depreciation. If you have a commercial property, it's longer, it's 39 years. Of course, the land piece is not depreciable. So depreciation give you a decent tax minimizing way. So you're not paying any tax, but there's no cash flow, but it's just simply cost recovery. That's why a lot of residential rental property, they don't pay any tax because they end up with zero or rental loss. So you really, that's why the rental investment is so appealing, is because you get the cash flow, but you don't really pay any tax. Um, if you have a rental loss, unfortunately, the rental activity are defaulted to be a passive activity. So that's why your rental loss cannot be offsetting your wage, like business income, because those income considered to be active income. So the rental loss you have been carried over, and they basically each year when you have a rental loss, then you carry over and you accumulated your rental loss until the year when you eventually sell your property, then all the rental loss will be released, will be able to offsetting your rental income or other income. So that's why the rental loss remain passive, cannot be offsetting your other wage or business income until the year when you finally dispose your property. So everything you can deduct. There's a summer break. If you have adjusted gross income between 100,000 to 150,000, and you have 25,000 loss, which this part of loss you can offset in your wage income. So this is the tax breaker for not for the dealer, but for the individual investor. Most people can use that loss to offset in your wage income, but your AGI cannot be too much. But if your AGI is over 150,000, then the deduction are gone. You don't get any deduction for that 25,000. So let's talk about the capital gain when you sell your rental. There's several simple steps for you to follow when you eventually sell your rental property. First, you need to calculate what's your adjusted basis. So the step one, the adjusted basis is the original basis when you purchase the property, plus what the improvement that you have done to that property. Put on roof and maybe add like attachment, those kind of major improvement, not a repair. It's like a major improvement. You don't deduct those improvement, you basically add to your basis. Then you minus the depreciation taken for the year when you rent your property. So this formula gives you how you calculate the adjusted basis before you calculating your gain. The step two is we actually calculate the tax gain. Then what's your sale price minus what's your selling expense. The selling expense basically is those expenses you see in your closing statement, like commission and all the other all the real estate expense. So those are called selling expense. Then you minus the adjusted basis, which you get from the step one. Then now you know that's the gain part. Then step three, you need to calculate what's the tax. So basically the tax will be the tax rate times the gain you get from step two. But that's two parts. So if you never rent your property, then it's a simple. So the step three, the result will be times long-term capital gain rate if you hold for more than a year. And for capital gain, for different people has a different tax rate. If your taxable income for single is less than 40,000, for married couple less than 80,000, that's mean total taxable income. That's mean your everything added together, and your tax gain is 0%. You pay 0% if you're under this income threshold, which is basically it's a 12% tax bracket. You pay 0% capital gain. But above that, in most people pay 15% for long-term capital gain. If your taxable income reached the really top level, like over 400,000, then your capital gain become 20%. But most people end up with paying 15%. So when I say two parts, if you have rented your property before you sell it, so you take a depreciation, and all those years, the accumulated depreciation, those depreciation, when you sell the property, this part of depreciation need a recapture. It's called it's called a 1250 gain, which the tax rate is different. It's a 25%. So let's say, for example, if I bought this rental property for $10, and I rented it for a couple years, and my accumulated depreciation is like $2. So the $10 minus the accumulated depreciation $2, now my basis is $8, right? If I sell my property for $20, so the $20 minus my adjusted basis of $8, I have $12 gain. But that $12, not everything is a long-term capital gain, because I have been taking $2 of depreciation. So of that $12 total gain, and the $2 will be taxed at 25%, the remaining of $10 will be taxed at a long-term capital gain. So it's only happen if you have rented your property before. So now we're talking about the flipping. If you're using your principal residence, and then we call it a tax-free flipping. It's it's the safest way and the most cost-free way. Because everybody know we have a principal residence gain exclusion. For single up to 250,000 gain, for married couple of 500,000 gain. You get a gain exclusion, but under the condition you live in that house for 2 years in the past 5 years. So this kind of exclusion, you can only be claimed every 2 years. So you cannot do for every year, because you have to live there for 2 years. So for flipping for purpose, if you really wanted to not paying any tax, why you not just buy the property and move it and live there for 2 years? Then you can sell. You can claim the like a principal residence exclusion every 2 years. So that in my prepared notes, in my slides, basically you say you can sell your principal residence every 2 years without paying any tax, as long as you live there before you sell. And this gain exclusion even apply, even you have been living in the house for 2 years, then you convert to rental property, then you sell it. As long as you're doing all this within 5 years, and you have been living in this house for 2 years, you are qualified to have the gain exclusion as well. But the only catch is all the accumulated depreciation you have taken during the period that you rent the property, this part will be recaptured as a gain. So the only gain you will be recognized, need to pay tax, just this part of depreciation you have taken in the past. This is very tax-friendly tactic for people, give them some option, and when they deal with the real estate property. What if you sell before you reach the 2-year like ownership? Then the entire gain will be subject to capital gain unless you never rented it before. But if you hold for less than a year, then it's a short-term capital gain. The short-term capital gain actually taxed as ordinary income. So it's like the same as your wage income, ordinary business income. So using your marginal tax rate. Depends on tax bracket you have. And as long as you hold for more than 1 year, then you have long-term capital gain, which is 15% for most people. So I'd like to touch if you're not using your private residence, just a regular fix and flip. For most real estate investor, if they buying, renovating, and selling within a year, then as I mentioned before, it's a short-term capital gain using your marginal rate. If you selling more than a year, if you do more than 2 years and living using as a principal residence, it's a free. So as I mentioned before, but most people cannot do that. So the suggestion I normally to my client is, what about you just hold for one more than a year? Then you get a long-term capital gain. And I had some projection for one of my clients. We actually calculate how much extra tax he will pay if he sell within a year, because he want to compare the mortgage interest he pay versus the saving of capital gain tax, see which option gives them more cash flow. So I normally do those kind of comparisons for clients before they make a decision if they want to sell before reach 1 year. If you have a loss, and the capital loss, unfortunately for individual person, each year you can only deduct 3,000 a year. So you just keep it 3,000 a year until you use up your loss. When I say capital loss limit 3,000 a year, is each year you can using the 3,000 capital loss to offsetting your rest of ordinary income, like a wage income. One thing I want to remind folks is, if you are doing that too frequently, like you do house flipping, several house at the same time, or each year you do several house flipping, you have some exposure to actually raise to the level of a dealer or trader. If IRS character you as a dealer or trader, not just the individual investor, then the tax consequence will be different. Just keep in mind, if you are a real estate investor, if you're an individual investor, you sell your flipping property, it's a capital gain, right? It's a preferential tax rate. But if your activity do too frequently raise to the level of a business and become a dealer, then it's a different. So the house in your hand, it's not a capital asset anymore. If it's not a capital assets, you don't get a capital gain. And the property you held for sale simply become your inventory. So your gain is taxed as ordinary income, regardless if you hold for less than a year or 1 or more than a year. And that's not the end of bad news. And also, as if it's become your ordinary business income, then you need to pay self-employment tax. Self-employment tax is a second level of tax, which is in addition to income tax, which is 15.3% for your ordinary income. Most of realtor pay self-employment tax unless they do something to restructure with my help, by the way. So the self-employment tax apply if it's become your business income. And IRS has some eyes on flipper, and there's some like kind of like warning sign how IRS determine you are dealer instead of the investor. For example, if they see several 1099-S appearing on your 1 year tax return, and or you doing like a whole, like a subdivision, and you do flipping several property do at the same time. That's why you have a bunch of 1099-S appear on your tax return. Then it's just to give the IRS a signing like you are doing, this is your business. It's not your investment activity. Once it looks like a business, it will be your business. They will try to enforce you with ordinary income treatment instead of capital gain treatment. So I'm going to talk about some tax planning idea, how to avoid that consequence. But I like to touch on, also want to touch on people asking, hey, I do fixed flipping, and what expense I can deduct. So I list these are the capital expenditure. Those expense like it's default. You cannot deduct as an ordinary expense. You have to capitalize into the basis of the house, and you can only take a deduction when the house eventually gets sold. Of course, including the purchase price and the material you're using during renovation, and also the labor you hire during renovation, and including the building permits or finder fee. Those are kind of like expense we call capital expenditure. The second slide is some kind of deductible expense, but it all depends. If you bought your flipping property, then you turn into a rental, and you have some rental income before you eventually sell your property, then some of the expense you may be able to deduct to offsetting your rental income, especially like a repair and those travel expense to look at your property, and some office expense, insurance, and the depreciation during the period while you rent for your property, and some interest, the real estate tax, and some legal accounting fee to your book, etc. But for the preparedness for most individual investor, we have been recommend our client to capitalize all your flipping expense until the time when you eventually sell your property. So pretty much all the expense will be capitalized into your basis until you sell your property, unless you have some income during the period time. So it all depends on facts and the circumstances. Record keeping is very important. Because you try to have a record of each house, and you want to check the expense you spend on each house. And some of the savvy real estate investors, they're using the accounting software such as QuickBook. If you're using QuickBook, and the QuickBook give you the option, you can use a different class. So you can put each rental activity in one class. Literally, it's like a setup department. So you put several departments for each of your flipping house. So in that case, you have a summary of what exactly expense you spend on that flipping property, so you can deduct when you eventually sell it. And it's very important that you check what you spend with the vendor, contractor, interest, etc. And some of my clients, they even have a separate checking account. And I know it's hard for most of folks, but if you want to be really savvy, really tax smart, you can do that.
Quick question for you.
Sure.
Do you recommend QuickBooks over Quicken, or just how are you feeling about QuickBooks or Quicken?
My preference, I like a QuickBook desktop version. I don't like a QuickBook online because it's just, I find it's very hard to access to. But I normally recommend my client to get a QuickBook Pro, which is it's a version of QuickBook, which is a little bit, has everything. And you probably don't need a payroll function. You get a QuickBook Pro, you can get from Walmart and Costco, maybe $200, give you a very decent QuickBook package, and you can print out your financials anytime. So
Thank you.
The other advantage of using the desktop version is that you can run multiple companies through
Yeah.
the desktop version versus if you're using QuickBooks Online, you're only allowed one company per license. And then if you have multiple LLCs or something, it suddenly,
Yeah.
all of us, your costs add up month to
Yeah.
month.
All my clients using QuickBooks desktop version because I told them I don't like a QuickBooks Online. Okay. So I'm gonna continue. People are more interested in the tax estimate. Self-employed person, the most problem with the self-employment person is they never pay any estimate tax. And towards the end of the year, the most common question I receive from my client is, I have not paid any of my Q1, Q2 tax yet. What should I do? First, why it's important to pay estimated tax, because the estimated tax is basically it's required for everybody as long as your tax is more than 1,000. And you are subject to underestimate the penalty if you're not paying 100% of prior year or 90% of current year tax. So my suggestion to my client is, why don't you just pay right now? If you have a little bit of cash, why you wait? So if you pay right now, at least your underestimated penalty can be reduced. And instead of wait until next April and you pay thousands of underestimated tax and you don't want to pay a little bit more whenever you have cash. So I always tell my client, pay now, don't wait. And that's one tip I'm going to share with you guys. It's better to pay estimated tax as in a form of withholding instead of pay like a Q3 estimated tax. And the tip I give to most of the business owner is, how about make your Q4 wage and 100% to your tax withholding, or make your bonus. If you get a $100 bonus, make $100 tax withholding. You don't get anything, but you can minimize your underestimated tax. The difference between as a withholding versus as quarterly estimate is, if you pay quarterly estimate in Q3, you are short for Q1, Q2. So you owe underestimate tax for the first 6 months. But if you pay as a withholding, even you pay at December 31, 2020, you pay $100. That $100 withholding is treated as if you pay evenly throughout the year. So it plays very well if you can make it as a withholding instead of to be estimated tax. And another technique a CPA like us would normally to use to help client to minimize their penalty is, we will ask, did you receive your income evenly throughout the year? And a lot of my real estate agent clients, they will tell me, oh, I'm very slow in the first 2 quarters, but I'm getting more business done maybe in Q3 or Q4. So I will annualize the income to show really the income is not evenly. That's why we're not paying any estimate in the first 2 quarters, and we pay more to make up in the Q3, Q4. So that's another way we can use to minimize your underestimated tax. This is all I want to say about the tax estimate. But again, if you have cash, pay right now, don't wait. Okay, so here's some of the tax smart tip we normally give to my client. If you are a real estate investor, I mean individual investor, you do your flipping like a property activity occasionally, not your regular business. Then the best way is you move into your investment property, hold for 2 years. Then you can sell as your principal residence. Or even you could put it into the rental for now. And then you sell it. And it doesn't look like you are doing flipping for business. You are not a regular flipping, and all your income is not from your tax flip activity. And another thing is like if you be patient and you get rewarded, right? Hold your activity more than a year, so you get a long-term capital gain. And you try to avoid multiple 1099s in one return. So don't do several property all together or within a year. Try to put it in a separate year. So just reduce the red flag. Don't let the eyes see the red flag in your return. And if you have a rental property, and my recommendation is to try to actively manage your rental. Pay your expense yourself, and get a contract, get a repair yourself, or even you can hire the property management company to manage for you. Try to avoid the triple net lease. The triple net lease is for those people only collecting rental income, not doing anything, because the tenant pay everything. The difference between triple net lease, if you active manage your rental, is if you active manage your rental, your activity looks like a trade business. So you can get a 20% qualified business income deduction for your rental profit. But if you are triple net lease, you're just simply collecting your rental check. You don't get a 20% deduction. If your rental profit is $100, for people manage their rental, they only need to pay $80. They need to pay tax on the $80, but the triple net lease people, they pay $100 because they don't get a 20% deduction. And the tip 5 is very unique for individual investor, which is 1031 exchange. It's remained very popular. I want to say this is unique because this is only available for real estate investor, not for trader or dealer. Because for trader dealer, those of house are their inventory. So the inventory, they are not qualified for 1031 exchange. But even only you hold it as a capital asset, which is qualified. I'm gonna come back to visit the 1031 exchange, assuming I have time. So what if your activity raised to a dealer or trader? You regularly make money through that, and all your money is come from house flipping. My suggestion is first you need to incorporate yourself. Don't run as a sole proprietorship. You need to run under an LLC, even a single LLC, that could help. Because the LLC versus a sole proprietorship is, if you are sole proprietorship, you are still under you. So your business liability and your personal liability has no difference. But if you are LLC, you are covered by the LLC, and it's like a corporation, like a veil. So you are shielded. So if the business liability will not become your personal liability, if you have a lawsuit, your creditor can only take away your maybe laptop, your furniture, which is used by LLC. They cannot come to your house to take your sofa, take your TV. So that's the difference between LLC and the sole proprietorship. And of course, you are in the trade business, you are qualified as a 20% qualified business income deduction. Basically, your profit is qualified to only be taken like a tax on 80%, 20% will be your deduction. One of the most popular tax saving technique or structure change I do regular for majority of my client is when their income is get to a decent level, I will make S election for their LLC. When we say S election, is we elect to be treated as an S corporation just for tax purpose only. For business purpose, for legal purpose, you are still under LLC, no change. I can help you to make an S election so you can treat it as an S corporation to save your self-employment income tax. I'm gonna put in more detail after that. So this strategy is best used for personal service provider. But why? Because for those personal service company, they really has no expense. All their income are subject not only for income tax, also for self-employment tax. It's the best strategy for realtor, general contractor, consultant, insurance agent, medical professional, doctor, attorney, you name it. So far, that's why there's so many S corporation in United States. That's the reason. It's the most S corporation, S election is the most tax efficient way for a business person. Let's talk about the self-employment tax, what a tax exposure you have as a business owner. If you are a dealer or even you are a realtor, you are subject to self-employment tax. So that's mean if you make $100, you not only pay income tax for that $100, you also need to pay 15.3% self-employment tax, which is Social Security 12.4 and Medicare 2.9. You are subject to self-employment tax, even your net profit is more than $400. So the threshold is really low. This is a difference from your wage income. If you are earning wage income, if you receive W-2, you don't have self-employment tax because this is your employment income. It's not a self-employment income. And if you earn wage income, as long as if you are single, your income is under 12,000, or for married filing jointly, if it's under 24,000, you don't even need to file tax because you are under the allowance. You don't need to file tax. A lot of people file tax simply get their refund, tax withholding refund. But that's different for self-employment tax. Self-employment tax, the threshold is really low. It's $400. Everybody need to file self-employment tax for all the self-employed person. So I have an example. So Linda is my client, and Linda is a realtor, and she is operating under a single member LLC, which called Linda Realty Group. And her commission is $80,000. She used to report on her Schedule C with her individual tax return. And assuming Linda's husband is not working, so verifying jointly. So the tax result is for Linda with $80,000 income, her tax bracket is only 12%. So she only paid $3,677 for income tax. But look at how much self-employment tax she paid. She paid $12,440 self-employment tax for the $80 Schedule C income she received. Most of the client, if you are not familiar with self-employment tax, they will be shocked by that tax bill because they pay more attention to the income taxes. They never look at the other tax line. And then they ask, why I'm paying so much tax? Then I said, oh, because this is for the 15.3 self-employment tax. That's why it's only for self-employment person. You pay two kinds of tax. What's the solution? So my solution for Linda is, how about we make an S election to elect your LLC to be treated as an S corporation. So this is just for tax purpose. The difference is Linda's profit is still $80,000, but instead 80,000 all is her self-employment income. I put the egg in two baskets. The first basket is her wage. So basically have her LLC to hire Linda as an employee. So basically you are hired by your own LLC. So you become employee of your LLC. So we call shareholder employee, and you receive W-2. So I say, how about that you make your W-2 income 40,000, then the remaining profit after W-2 is another 40,000. And the tax law say, as long as you pay yourself reasonable compensation, the net profit after your compensation is not subject to self-employment tax. So I'm gonna give you the example later, see how much tax she own. She actually saving, but by doing that, not put all the egg in one basket, and the remaining, the net profit piece, the 40,000 remaining after the 40,000 wage, and that 40,000 she does not need to pay the 15.3% self-employment tax. And the good news is still time to make an S election. And the law say, hey, if you want to be S election, S corporation for 2020, you need to make election by March 15, 2020. But we always do late election, which as long as you give reasonable reason, and I can even make S election for 2020 at the December 31, 2020, and the reasonable reason we always give is my attorney mess up. So this is the like a reason we always use to make a late S election. So I have an example to show you, see if we see the first column is if it's keep Linda as a Schedule C filer, and her income business profits 80,000. And the second column is after we make an S election, we basically put 40,000 to her wage, and the remaining 40,000 as a profit. And if you scroll down towards the end, you probably see SE tax 15.3%. And if it's under the older structure, she not only pay income tax of 3,677, she also pay 12,240 SE tax. But after we made a change in the second column, and she only pay 5,372 for income tax, not paying anything for the 12,240. So that part is her saving. Of course, we put 40,000 to wage. So you pay for your wage income, you pay employee tax, employer tax. So that's why I add the second line to the end. The total tax for on her wage is 6,120. But even after the tax she pay on her wage, her total tax liability is 11,000 compared to the almost the 16,000 that she paid before. And in a single year, her tax saving is about 4,400. It's not as for 1 year, because after many years, so you will see that the tax saving is really tremendous. It's just a no-brainer not to convert to be make an S election. That's why I say this is the most effective way for personal service corporation, because she has no expense. All she has is income. Okay, so I'm talking about the make an S election. If anybody has a question, feel free to email me. And I did a lot of S election for my client, and we also help client to set up a payroll code. As a shareholder, if you are only owner, you don't need to set up a payroll monthly, you can do quarterly. So save you some of the compliance tax. So we have a lot of single business owner actually doing payroll through my firm as well. So we kind of like a whole set of the service we can provide. For individual investor, and the 1031 exchange remain very popular. 1031 exchange has been going on for over 100 years. Still quite popular. And the 1031 exchange is really it's really helpful when you have a capital property which you have very low basis. For example, if you bought this rental property like 20 years ago, you maybe only pay $10 for that rental property. After you rented for 10 years, then you take a 10 years of depreciation. If we say depreciation expense accumulated for those 10 years, like $4, then you have your original basis 10 minus $4 of your depreciation. Now your tax basis is $6. What if you, with the market, now the fair market value is $100. If you're gonna sell your old rental property, you will pay $100 minus $6 your basis. You need to pay $94 gain, which it's a really huge tax burden for a lot of people. They don't want to pay that tax. So that's why 1031 exchange pop up. It's the great saving opportunity. What if we just exchange to another rental property? So as long as you do a complete 1031 exchange, you find another property, maybe Florida, like Nevada. You find another property which has more appreciation potential, and you can locate to other place, or you dispose those underperforming property, and or simply you want to get some cash back. You can do 1031 exchange and to achieve those goals, but the bottom line is I don't want to pay the tax on that $94 gain. So you can see the trade-off is you do the exchange, but even you with your replacement property, if you're not paying any tax, your basis keep no change. You still only have $6 basis in your replacement property. If you don't want to pay tax, you can keep doing 1031 exchange. You can keep doing it. But when eventually you need to sell the property, and then it's the time you pay the $94 tax. So it's just the deferred tax. It's not the gain, the tax gain is not a disappear. It's just a defer. If you really wanted the gain disappear, that's a two-way you probably could do that. You probably could donate your property to the nonprofit organization. Then you can claim the deduction for the fair market value, and which you don't need to pay any tax, which is a great saving technique for those wealthy clients. And or another best way, I think, for most people is hold on to it until your deathbed. So you hold on to it and you pass the property to your family member on your deathbed, and all the property get a step-up basis. In that case, you don't need to pay tax. For example, if you hold on to it until the date of your death, and you pass that to your kid, and your kid, because it's through the inheritance, so that rental property can take the fair market basis is $100, and in your kid, the basis is $100 is because it's passed on the deathbed, get a step-up basis. If your kids sold the house for $100 and he has a $100 basis, then he does not need to pay any tax. So that's why you often time here, death is the best saving. So that's the another way you probably could avoid tax. Other than that, 1031 exchange just give you the deferred option. There's a tax rule change after 2017. After 2017, the 1031 exchange only apply to real property. You cannot do personal property for 1031 exchange anymore. In case some people not familiar with that basic rule, I just want to give you some basic knowledge about the 2 dates you really need to follow to do a complete 1031 exchange, which is a 45 days rule and a 180 days rule. The 45 days rule is, that's mean after you sell your relinquished property, you have 45 days to identify your replacement property. You can identify like maybe up to 3 property, and you can eventually exchange for 1 or 2 or all 3 of them. Or if you want to identify more property, then your total value of your replacement property cannot be over 200,000 of your relinquished property. So that's some basic rule underneath the 45 days rule. Of course, how you identify the property is with the 1031 exchange, we always has the qualified intermediary involved. So you need to put it in writing to let your intermediary know what replacement property you want to exchange to. Of course, the qualified intermediary property intermediary will hold your cash. You cannot get your cash. You cannot get cash when you sell your own property. You have to transfer the money to the intermediary. Then the intermediary will transfer the cash to the replacement property owner. Then we also have the 180 days rule. 180 days rule mean you have to finish the whole 1031 exchange within 180 days after you sell your own property, your older property. So the 180 days, which is also you could be also you need to be done by the due date of the tax return for the year when you sell your older property. Of course, oftentimes, and the 180 days is come before the tax extended the due date. That's why we typically in general just refer to 180 days. That's why find a good qualified intermediary is very important. So they do a pretty decent job to hold your cash and to help you finish the deal, and very low cost, only a couple $100. So that's why it's a cost is not the problem with 1031 exchange. The 1031 exchange problem is always the timing issue, and a lot of people cannot follow the 40 days rule, and they cannot complete the deal within 180 days rule. That's why you have the like a fall apart 1031 exchange, which is, it's horrible news for the taxpayer because they end up have to pay the tax, even they want to do 1031 exchange in good intention. The 1031 exchange, normally they cover those income producing property. So let's say, for example, your home cannot be the property for 1031 exchange. There must be some property which generate the income for you, such as a rental property, commercial property, and like kind. That's mean the property needed to be like kind. Doesn't necessarily need mean you have to develop it or undeveloped. So the parameter is quite broad, such as undeveloped land. You can 1031 exchange for developed land. You can exchange your residential rental for a commercial property. So the parameter is quite broad, as long as you follow mainly it's the timing, the dates is the most crucial for a successful 1031 exchange. And it's 1031 exchange sometimes works well for people if they don't want to exchange all the single value, they do want to get some cash out. And you probably could exchange you for your property worth $100 for another property only worth $90. Then you get a $10 cash back. You get some cash flow. But the trade-off is if you get any cash back, this cash you need to recognize the gain. So it's not a total tax-free. So for a tax-free 1031 exchange, you must exchange single fair market value, say similar to the with another replacement property. Or if you have a mortgage with your older property, if your mortgage get reduced, those are treated as a cash as well. So that's why we call boot. Boot is taxable, but at least you probably could avoid the majority gain, not avoid, I put it back, it's just defer majority gain if you can do a successful 1031 exchange. And another one, one thing I want to emphasize is 1031 exchange actually is quite a complicated tax rule. It's quite, it's like a complicated calculation to calculate your older basis versus your replacement basis, replaced property basis. Whenever you do a 1031 exchange, please make sure to find a CPA. Pay a couple hundred more to find a CPA, do your tax reporting. Do not go to the tax preparer. I cannot tell you how many times I review my client's return or I do a second opinion review for some new client. And the tax preparer has no CPA license. They only have a certificate. And they don't understand the 1031 exchange rule, and they did a bad job in calculating your basis. Because the soul about 1031 exchange is if I have a tax basis of 10, I exchange for another property, I should get the same basis. My basis should carry over, right? Only in with my replacement property, my basis keep as 10 as well. So in that case, in the replacement property, I can continue to depreciate using my 10 basis, which carry over from my old property. A lot of cases I saw people with the 1031 exchange just bad reporting, and they totally remove the gain and the gain becomes zero. So it's just it's tragedy if you have some not qualified people do 1031 exchange for you. And also they calculate a lot of gain for client, but even really should be no gain. So that's why I'm begging you, if you have 1031 exchange, find a CPA for tax reporting. Yeah, this is all I have for tonight. And people have a question, feel free to ask. Yeah.